Okay, so good afternoon, everyone. Good afternoon once again, everyone, and welcome to our first class on forex trading. Okay, so first let me start by introducing myself. My name is IDOWU-ADEYEMI Anoluwapo, and I currently, this training is brought to you by trade.com. Trade.com. Trade.com is a forex brokerage firm here in Nigeria, and I happen to be the trainer here at trade.com. Okay, so the essence of the training is just to give everyone, it's to empower especially the youth. That's the goal of the training. We want to empower the youth as to when it comes to forex trading. Okay, so to kickstart, let me confirm. If you can see my slide, please type in one on the chat box. If you can see my slide, please type in one on the chat box. If you can see my slide, please type in one on the chat box. If you can see my slide, please type in one on the chat box. If you can see my slide, please type in one on the chat box. If you are not seeing my slide, please type in two. If you cannot see my slide, please type in two. Oh, okay. Okay. So at least I can confirm that you can see my slide, even if it's just two people that is responding at the moment. Okay, thank you. Oh, thank you. Thank you, guys. Okay, so for the purpose of today's training, as I said earlier, it's brought to you by trade.com. And the purpose is I'll be assuming that everyone on this call has little or no idea about Forex trading. So I'm going to make it number one, as simple as possible to make even a 2 years old child, a 5 years old child understand. So I won't make it so complex. I'll make it so simple in which everyone on this call will be able to understand what we are talking about. Now, for my slide, you can see for today we'll be trying to understand the basics of forex trading. We want to understand the basis of trading the financial market. That is it. What we'll be looking at today, and that is the module one of our training. It's the module one of our training. Now let's look at the table of content. What exactly are we going to be treating today? So these are the topics we'll be looking at today. We'll start by looking at what exactly is forex trading. Then we'll look at the structure of the forex market. Then that leads us to what are traded in the financial market, then how to trade. Now, this, as I said earlier, is the module one. So it means that we have various modules to go, but this is the module one. So we'll be looking at what is forex trading. We'll look at the structure of the forex market, then what are traded in the financial market, then how to trade. Okay. Let's start with what exactly is forex trading. Now, I want to believe at one point or the other, you have heard about forex. I want to believe at one point or the other, you have heard about forex. Now, some people understand it when they hear it, while some people may not understand it. So now let's look at the word. What exactly is forex? Now, when you see forex, you see foreign exchange markets, you see FX markets. All these are the same thing. So some people call it the FX market. Some people call it the FX market, some call it the Forex market, some call it the foreign exchange market. All these are of the same interpretation. They are just used interchangeably. Now, what exactly is it? It is a global decentralized market for the trading of currencies. Now, I will not even use the trading of currencies for the trading of financial assets. So when we talk about the foreign exchange market, it is a global decentralized market. Now, when we say decentralized, what does this mean? It means that when we are talking about the financial market, when we let's look at the opposite of decentralized, we look at centralized. Now when we say centralized, it means that there's a point in which everybody needs to meet. Let's say, okay, we have this phone, and we have different channels to this phone, different channels to this phone. Now that's a central, meaning that this phone becomes the central linking different channels. But when we talk about the financial market, what this means is that it is a global. When we say global, it doesn't restrict you to only Nigeria. It is everywhere. It's a global market. But the beauty, it is decentralized. That is, it's it is controlled by many. Let me just use it that way. It is controlled by many. So one person cannot determine what is happening there. And that's why we use the word decentralized. It is not determined by a particular entity or by a particular person. It is decentralized. So what this means is when it comes to pricing, it is determined by various people. Why? Because there is no particular person that manages the market. So that's why we call it is a global decentralized market for trading of assets, financial assets. So I don't want to use just currencies, but financial assets. That's one. Now, the second one is it helps to facilitate international trade. That's another definition. Okay, sorry for that. So as I was saying, it helps to facilitate international trade and investment. So sorry for that. I'm so sorry. Please, I'm sorry. I'm sorry. Okay, so let's continue. So, as I said, it helps to facilitate international trade. Now, why do we say it helps to facilitate international trade? Now, when we talk about currency, what exactly it does it mean? It means that you are trying to trade different countries' currency against another. Now, let me use an example. And this is exactly Forex. Okay, let me use an example. Let's assume I plan going to US tomorrow. Now, if I want to go to US, automatically I cannot take my naira because I'm coming from Nigeria. I cannot take naira to US and I expect I can use it to buy anything. It's not possible. The moment my naira gets to US, the money, that currency becomes like a paper. Why? Because what makes it money is because it is generally acceptable for the transaction of for the purchase of different transaction. But when I take naira to a particular jurisdiction that is not acceptable, the money becomes useless. Now, having said this, when we now talk about it helps to facilitate international trade, let's assume I'm a business person and probably I deal with let me use spare parts. Let me use maybe spare parts. And probably let's say my majority of the things I buy let's say I buy them from China. Now, what this means is this: it means that the moment I decide that I want to transact, I want to buy raw materials for my business, I cannot take Naira to buy it. It's not possible. So automatically, I need to begin to look for how to exchange my Naira to Chinese yen, so that I can use it to buy whatever. So that's why we say that when we talk about forex trading, it helps us to facilitate international trade. When we say international trade, it means that when you're buying, you want to buy from one location or from one country to another, automatically you need their currency. Now, this is another thing that begat forex trading. So it helps us to facilitate international trade and investment by enabling currency conversion. Now, the last one say it is the largest financial market in the world with a daily trading volume exceeding $6 trillion. Now, what this means is this: if I wake up today, okay, let's assume, fine, the market doesn't open today, the market doesn't open Saturdays and Sunday. But let's assume I wake up on a Monday or probably on a Tuesday and I decide to trade. Now, what this means in my subconsciousness is that I have access to make 6.6 Why? Because the money that is available to make in the financial market is $6 trillion. So because of it's a large volume, so it means that how much I want to make is determined by me. I could say that I want to make the entire $6 trillion. I could say, okay, out of this $6 trillion, I just need probably maybe $1,000 on a daily basis, or maybe I just need maybe $2 on a daily basis, dependent on me. Now, these are just what we explain when we talk about forex trading. Please, if I am making sense, I want you to type in one on the chat box. If I'm not boring you, I'm making sense. If I'm passing knowledge, please just type in one to encourage me on the chat box. Please type in one on the chat box. Oh, thank you, thank you, thank you, thank you, thank you, thank you. I just wanted to be sure that at least I'm not wasting your time. And remember, I told you, I promise you will be getting value for today's presentation. I won't waste you. I won't bore you at all. You will get value. And I want to make sure I explain it, assuming that I am teaching a 5 years old boy, a 5 years old girl. So I'm not going to be using too much grammar to bore you. I will break it down as easy as possible. Now, let's go to the history of forex trading. Now, the truth is, whatever happens, always have an history. Now, let's look at what exactly brought about this opportunity for you and I. Now, the opportunity came from trade by barter. I can remember when I was in when I was in secondary school, when when they were teaching me economics, that they were trying to explain trade by barter for me. Now, forex is gotten from trade by barter. Now, what exactly do I mean by this? Let me just give you a little explanation when I talk about trade by barter. Now, when we're in economics class, when they were explaining trade by barter, they made us to understand that now, when we talk about a particular, let me say, country, now, in a particular country, there may be something, you may have something better than another. Now, what do I mean by that? Maybe in Nigeria, or let's even use Nigeria. Now, in some states, like the northern states are good with farming. They're good with farming. Now, at the eastern states, it's their own, what they are good at is different from what they are good at the north. So also at the eastern part. Now, this is just within Nigeria. Now, let's look at globally. Now, globally, some countries are good with something, while some other are not bad in that thing, but they have something else that they are good at. Now, let's say for instance, in my family, we are good at maybe cultivating yam. Let me use that as an example. Now, if we are good at yam cultivation, and let's say we only cultivate yam, naturally, it will get to a time in our life that we are tired of eating yam. Now, the reason is because we tend to eat more of yam because that is what our strength is. But there will be a time in our life that we yam becomes boring to us. We don't want to eat yam. Now, gone are those days. They don't have access to money. They only have access to something they are good at. Now, what trade by barter does is this. It make me, because I am good at yam, I will take my yam and then maybe I'll go and meet Mr. Sherry's family. I can go and meet Mr. Sherry's family. And let's say Mr. Sherry's family, they are good at clothing. I have yam. I don't have clothing. I don't know how to do it. But Mr. Sheriff is good at clothing. Now, what I could do is I need to go and meet Mr. Sheriff and ask him, Mr. Sheriff, I have yam. I don't have clothing, but I need clothing. Do you need yam? Now, the only way myself and Mr. Sheriff can successfully transact is if he says, yes, I need yam and I'm ready, me too, I need clothing. So what we can do is we cannot agree on the way of measuring it, in which I will give him my yam, in exchange, he will give me clothing. Now, this was how international trading was done. Gone are those days in the year 1990s, in the year 1900. Now, those are the way they do it. So what it means is there is always a period in which people take their goods and services to some people so that they can see. So there is always a, we call it a marketplace now, which they agree. Now, every part of the world meets at that point. Now, when they meet at that point, individual, they will provide what they have. Why they look for someone that need what they have and they need what the person have. And that's trade by barter. Now, this continued, but it got to a level in which there was a problem when it comes to how they measure the value. Now, let's assume I have 10 tuber of yam and I want to collect clothing from Mr. Sheriff. Now, for me to be able to successfully do that, Mr. Sheriff must be able to measure the quality. It will tell me, okay, one unit of clothes I can give you with one tuber of yam. Now, I will not be like, take this cloth that is just it doesn't have value. I will not give you a whole tuber. Now, it means that we also need to agree as to the value of measurement. Now, this was a limitation when it comes to trade by barter because people find it difficult to agree as to the measurement of value. Now, when this got to this point, when they got to 1944, then the Bretton Woods Agreement came in. The Bretton Woods Agreement. Now, what does this mean? Now, when the Bretton Woods Agreement came in, what they did is they tried to establish a fixed exchange rate, linking every currency to dollar. Now, what this means is this. If, let's say, I want to buy, what's the name now? I want to buy my raw materials. Let's say I'm a business person, I want to buy my raw materials. Now, it will be difficult because I have Naira. And let's say my raw material, I'm buying it from China. Now, remember, if I want to do that, I need Chinese yen. Now, it will be difficult for me to be able to determine the exchange rate of my Naira to Chinese yen. So what they now did is, for every country that want to purchase any goods from another country, they need to first of all convert that currency to US dollar. Now, when they convert the US, so it means that if I want to purchase something now in China, I will first need to go and buy dollar. When I now buy dollar, the person that wants to confine in China too, we need to also buy dollar. Now, and that is why till today, dollar is very strong. This was what led to the strength of dollar. Because, it means that no matter the country that want to transact, they need to first convert that currency in as much as it's an international transaction. They find it difficult to determine the exchange rate of Naira to Chinese yen. So the only way they can do it is they will first convert it to US dollar before they convert it to another. So it means that this gave US dollar the strength. So gone are those days. Even if they went to a place they want to purchase things, they need to first try to convert that money to US dollar, then take that money to that other country's currency to purchase it. Now, this was how forex transaction. You know, when we talk about forex now, we're talking about foreign transaction. So whatever explanation I'm giving you is foreign transaction, not just Nigerian transaction. That is transaction between one country against another country. So this was what Bretton Woods Agreement brought to place. So with this, what it did is this decision only favored US dollar. And when they noticed that, because demand on US dollar continued to increase as a result of this, what happened? So with as a result of this, it led to the fact that the value of US dollar continue to increase. You know, it's the law of demand and supply. When the demand for something increases automatically, when the demand for something increases, automatically the price will also increase. So this led to the strengthening of US dollar, and that was when they realized that we need to put an end to this Bretton Woods. We need to put an end to the Bretton Woods. Now, when they put an end to the Bretton Woods, came in another law in 1971, which is now the floating exchange rate. Now, the floating exchange rate, what does this mean? It brought about to the modern foreign exchange. Now, with this new law, they now said, okay, let us, instead of every currency first exchanging to US dollar, let every currency be able to meet at one point in which they can put an exchange rate over every currency. And that is why, as at today, we can say if I need dollar and I have naira, this is the value. If I need Great Britain pound and I have naira, this is the value. If I need Japanese yen and I have naira, this is the value. So all this came to play in 1971 when they brought or they put an end to the Bretton Woods law. Are we still together? Hope I'm not boring us with too much history. Please, if I am boring you with too much history, please say boring. And if you are enjoying it, please type it. I'm enjoying it. Let me just know. I don't want to bore us too much. I know this is too much history for us. If I'm boring you, please put boring. If I'm communicating and you are enjoying it, please put enjoying on the chat box. Ah, Jesu Loba, this is heartbreaking. Jesu Loba, this is not nice. This is not nice. So I'm boring you. Okay. Any other one? Okay, no problem. Thank you. Okay, now. Okay, no problem. Thank you. Now, when they were able to put a rate over every currency, this was what brought about to forex. Now, why did it bring about to forex? Now, it means that there are two no in initially, let me use the word initially, there was just one reason why people want to buy foreign exchange, because they want to do international trade, they want to transact. Okay. Okay, Tijani said I should cut the history short and go to the main purpose. Okay, no problem. I'll cut it. I'm almost done. I'm almost gone. I'm going somewhere. That's why. No problem. So, as I was saying, now when what's the name now? When the exchange rate, when everybody could transact with their exchange rate, it means that if I need Great Britain pound, I don't need to buy US dollar. I can just buy it directly since I already have an exchange rate. But remember, at this time, it was not there was no it was not decentralized. It was still like a central place. There was still a place we need to go and meet. So over time came the technology era. When technology came to place, everything became decentralized, in which we can now do it on our phone. And this is where you and I were given the opportunity to trade. Now, when people begin to do this over time, they notice that apart from making money from interest from international trade, they notice because of the demand for different countries' currency, it bring about the fluctuation in the prices of the exchange rate. And this was what brought the opportunity for us to make money. So basically, the essence why we are learning this is to make money from the fluctuation, not making money from international trade. So we basically want to make money from the fluctuation of different foreign exchange rates. Okay, so let's move away from history and let's go on from there. Now, with this, let's look at who are the key players in the foreign exchange markets. Let's look at the key players. Now, number one, we have the central bank. The central bank. Now, basically, the work of the central bank is to help influence their currency value. Now, what do I mean by this? The job of the central bank is they don't want the value of their currency to either continue to go up or continue to go down. They don't just want the demand and supply to control their currency. So when they notice that, okay, let's say, for example, when the demand for a particular currency increases, automatically the price begins to go up. But the central bank doesn't just want it to continue going up as a result of demand and supply. Why? Because when the value of their currency goes too high, it reduces foreign investors to come and invest. So it also, over time, brings negative impact in their economy. So with this, the job of the central bank is basically to regulate the value of their currency. So the central bank are not there to make money from speculation like us. The central bank are basically there to make money from the regulation, from regulating the value of their currency. Now, how do they regulate it? They regulate it through different monetary policies. So when they notice that, okay, the value of their currency is going too high, they put in place some monetary policies to control it. Now, example of this, we have in Nigeria, we have the CBN, Central Bank of Nigeria. In US, we have the Federal Reserve, Reserve, and so on. Now, these are key players. Now, why do we say they are key players? Now, if the value of a particular currency is on the high side and central bank comes in, if they take a decision, it will change the direction of the market. And if you and I are trading, it can allow us to either make or lose money. So as a trader, we should always put in mind, not just because we want to trade, but what is the central bank of that country saying about their currency? Because this is what helps us to determine the movement of the currency. And remember, as a speculative trader, we make money from the fluctuation of that currency. Now, this is one. Another player, we have the commercial bank. Now, what exactly are the commercial banks doing? The commercial banks are there to facilitate transaction or provide liquidity. Now, what do I mean by that? Remember, for you to trade, you need different countries' currency. Now, as an individual, it is difficult for an individual, one person, to have all the currency of every part of the world. It's difficult. Now, as a result, we now have the commercial banks, the big people, to be there to provide liquidity, to provide money. Why? Because, the banks are basically where they have access to pool of funds. Different people go to the country and put their money. So with this pool of funds, they make the fund available to us. So basically, the commercial banks are there to provide liquidity. And it's not all banks that provide liquidities. We are talking about the big banks, the like of JP Morgan, the like of Citibanks, not Nigerian banks now. So when we talk about commercial bank, please don't think it is GT Bank or Eco Bank or Wema Bank. No, we are talking about the big bank. It's not even all foreign banks that provide liquidity. They need, we're talking about the big players, the like of JP Morgan, we talk about the like of Citibank. So they are the one basically providing liquidity for us. Now, for us to make money, we need access to the raw value. Now, that is the job of the commercial bank. Having said this, let's look at another player. We talk about the financial institutions. Now, when we talk about financial institutions, different financial institutions have different objective. Now, the like of hedge funds. Who are hedge funds? Now, hedge funds are basically organizations that help you to trade. Now, when we talk about hedge funds. Now, there are different type of hedge funds. It's not the one that is common in Nigeria that we hear people say, "Bring your money, I will trade for you." These are not hedge funds. Why? Because they are not professionals. Now, hedge funds are professionals. They are professionals that are, when they look at the money they collect to trade, they don't look at small money. They collect big, huge funds. Now, their major funds is they get pool of funds from different individuals. Now, because of this pool of funds, they gives them access to big funds at the end of the day. And with this big funds, they use this to take some positions in the market, in which when these positions are taken, it automatically affects the movement. It pushes price to that direction. Why? Because we are talking of billions of dollars now. We're not talking about just thousands. We're talking of billions, not even million, billions of dollars. Now, when these people take this kind of money to trade, it automatically moves the market towards that direction. Also, we talk about pension funds. Now, pension funds, now they also try to, pension funds, people give them full of funds. Now the question is, how do they get invest interest rate? How do they get generate funds? They generate more funds by also be parties or participants in the market. They also trade. But these ones, they trade not as an individual, but they trade as an organization, as an institute. So we have investment managers. Now, all these people, they are financial institutions that also participate in the financial market. Now, the reason why you and I should put this set of people into consideration is this. Now, when this set of people enters the market, we call them the big players. Now, because of the pool or because of the value of money they have, when they enter the market, if they enter the market into a particular direction, you will see it's like a spike. You will see the spike in the market. Now, what is causing that spike is the volume of fund that they pushed into the market at that point. And that's why anytime you are trading, you need to also keep track of what these big guys are doing. What exactly are they doing? Then we have the retail traders. Now, these are individual investors that participate using online brokers just like you and I. Remember, you and I, we don't have the big funds. We don't have access to the big banks like JP Morgan, like Citibank. So the only way we can get access is through the brokers. Through the brokers. Okay, so if we are still together, please type in one on the chat box. If we are still together, please type in one on the chat box. Okay, thank you. Thank you. Thank you. Okay, thank you. So let's go to the structure of the Forex market. Let's go to the structure. Let's go to the structure of the Forex market. Now, remember when we started about the Forex market, I mentioned that the Forex market is a decentralized market. Now, if you look at this chart, you will see that it's it has different channels. It has different channels. Okay, I can see some people raising their hands. Please, I may not be able to allow you to talk at the moment, but if it is important, you want to pass a message to me, you can drop it on the chat box. I'm going to see that and read it. If it's important, you need to pass a message to me. Please drop it on the chat box. Thank you. Okay, now one thing is, remember I said earlier that when it comes to the Forex market, it's a decentralized market. Now, it means that there are different access points that links you to the market. We don't have a direct one. They are different. So it depends on number one, the level of your funds. The higher your funds, the closer you can get access. The lower your funds, the tougher you can get access. Now, because there are different channels to which you can get access, so also there are different rates, there are different value. Now you will see some people, the rate they purchase or the rate they pay to get access is much more tighter than another. What makes them different is basically the type of funds they have. Now, if I have big funds and you have small funds, I will not be paying the same thing, even if we are taking the same position. Why? Because of the funds I have. So also, now having said that, let's look at the hierarchy. Now, when we talk about the hierarchy, we'll first start with the major banks. When I say major banks, I'm talking about the big commercial banks like the like of JP Morgan, the like of Citibanks. Now, these ones, they have access to every almost every country's currency. So they are the big banks. So it means that even the brokers you are seeing, they get access from this big bank. So you see the big bank. Now with this big bank, for the major brokers, they get access from the big bank. So the big bank automatically are their liquidity provider. They provide them the funds. Now, when they provide them the funds, what they, as the broker, what they have is they have the technology. Now, there are different things that you need to put in place for you to have access to the financial market. Number one is the funds, the big funds. That's the one that will provide you liquidity. Now, another one is the technology. So the brokers, they look for the technology. When they have this technology, they need to now go partner with the big banks to provide them with liquidity. Now, with this, the small banks will now partner with them. The small banks. When we talk about the small banks, now the truth is this: all these commercial banks in Nigeria, there are what's the name now? Their treasury department, they also trade forex. But unfortunately, they are at this level. Why? Because they don't have access to the technology. So they are using the broker. Remember, the broker already provided them with the technology as well as liquidity from these guys. So the small banks will now connect to them. Then this is where we will have the retail traders. So we have access to the retail brokers, the retail brokers. Now with these retail brokers come the retail traders, which is you and I. So it now means that if you have good money, when I mean good money, I'm talking about billions of dollars, you can move to either this level, but it may be difficult to get to this level. So depending on the money you have, you could either be at this level or this level. But if you're just looking at, okay, just to make money from speculation, then you can remain at this level, which is a retail trader. So that is the structure of the Forex market. Okay, let's continue. So let's go to the trading section. Now, I want to believe most of us have heard that, oh, the market is always open every day, 24 hours a day, 5 days a week. Yes, that is true. But one thing I want you to understand is this, that the market is open 24 hours a day doesn't mean that there is high volatility 24 hours a day. You need to understand this, that the market is open 24 hours a day doesn't mean that there is high volatility 24 hours a day. Now, high volatility is determined by the market section. Now, when I mean high volatility, what is volatility? Is movement. Remember, we are speculators. What we want to do is we want to make money from the movement. That's what we do. So it means that if the market does not move, we cannot make money. So as a trader, we need to ask ourselves, when will a particular currency move more? So that is when you want to trade it. You don't want to trade when the market is not moving. You are just tying your money down. So in order to determine this comes the market section. Now, when it comes about the market section, we have basically four major sections. We have four major sections. Now, the first one is we have the Sydney section. The second one, we have the Tokyo section. We have the London section, and we have the New York section. Now, the Sydney section is always in the midnight. Now, those that want to trade in the midnight, Nigerian time, when we are sleeping, if you want, maybe you woke up in the midnight and you feel like trading, you don't need to look for currency that fall under any of this. You need to go to the currency that fall under Sydney. So before you do that, you need to know what countries' currency fall under Sydney. Now, the Sydney market, they open 7 p.m., 10 p.m. in the night to 7 a.m. in the morning. 10 p.m. to 7 a.m. in the morning. That is when they open. So at this point, any currency, any country that is under the Sydney tends to be much more volatile. So when we talk about that, we're talking about the Asia now. So you need to now be conversant with this and they know when to trade. Then the next one, we have the Tokyo section. Now, the Tokyo section, their market opens 1 a.m. in the midnight to 10 a.m. in the morning. So if you want to trade around this time, then you need to look for the currency under the Tokyo section. Those are the ones that most. Now, if you love to trade during the day, then London and New York is for you. The London market opens 8 a.m. Nigerian time to 5 p.m. Nigerian time. The London section opens 8 a.m. to 5 p.m. Nigerian time. While the New York section open 1 p.m. in the afternoon till 10 p.m. in the midnight. So these are the trading section. So as a trader, I am giving you an assignment at this point. And what is my assignment? The assignment is go and research which country's currency falls under Sydney. Please write this assignment down. Which country's currency fall under Sydney? Which country's currency fall under Tokyo? Which country currency fall under London? And which country currency fall under New York? Please, let's do this assignment. Now, so because for you to trade, you need to know the country's currency that fall under each of these, so that when you now know this, you can now say, okay, maybe you woke up around 2 a.m. in the morning, then in the midnight, then you can know that you want to target only the Tokyo section. Are we all together? Are we all together? Okay, so this is the trading section. Now, let's look at the key features of Forex trading. Why do you think it is necessary for you to trade Forex? Why? Let's look at the reason why it is necessary, why it is necessary to even be in this class. Why do you think you want to be in this class? Why do you think you want to trade Forex? Now, let's look at some of the reasons. Number one, high liquidity. High liquidity. Now, what do I mean by that? Large volume of trade leading to low transaction costs and easy entry and exits. Now, what this means is, number one, when you're trading Forex, it gives you access to large volumes of trade. You can enter as many trades as possible, and you are paying as low as possible. So it means it's just like you want to buy something and they say, how much are you buying it? And they're telling you should come and pay big money. Now, the beauty about Forex is that you don't need to pay the transaction cost you're paying for buying a particular or for taking a particular trade is small. And it is easy for you to always enter and come out. So in as much as you have your phones or your laptop, you can easily enter the market and come out at every seconds, and you make money in as much as you know what you're doing. Also, another advantage is leverage. Now, what is leverage? Ability to control a large position with a relative small amount. Now, leverage is basically the broker borrowing you money to trade. So when we mean borrowing you, they are not necessarily borrowing you. You are just leveraging on the fact that, okay, they already have a platform. Now, naturally, if it's not with the services a broker provides, you cannot even trade with $100. The lowest you can trade this with is $1,000. if not for the services of a broker. And but with the broker, you can say, okay, with $300, with $100, I want to place a trade. So and what brings about this is leverage. So you're leveraging on their funds, you're leveraging on the capital of the broker to take position. But one thing I want you to understand is this, that you are leveraging. You need to understand that the more leverage you take, the more potential gain as well as loss if you are losing. So it means that when you have access to leverage doesn't mean that you should always use it at every time. Because when you lose too much leverage, if you make money, yes, you're going to make much more. But if you lose too, you're going to lose much more. So when you are using leverage, you need to use it with caution. With caution, that's the truth. Now, another features or another advantage or benefit of forex trading is that it is volatile. The volatility, frequency, and significant price movement. Now, within you will see people telling you that in 1 hour I make $10,000. What allows them to do is volatility. Now, the advantage of trading forex is price movement. The price moves at numerous periods. So it means that you have numerous trading opportunity. And so it's just about you knowing what you can do. So you can just wake up and let's say I give myself that, okay, I know I just have 2 hours to be on my system to trade. And funny enough, in 2 hours, I can make good money for myself. But if you say you want to open a shop, that you open a shop doesn't mean that people will even come and buy. But with trading, in as much as you have the skills, you know what you want to do. With the skills, you can say yourself, okay, in 2 hours, this is how much I have. I have $300. I want to make 2% of $300 in 2 hours. You can do that. Why? Because it is volatile. Price movement. You will always see opportunities. That's the honest truth. Lastly, accessibility. Opening to a wide range of participants, from small retail traders to large institutions. So no matter your level, I have big money, I have small money. It accommodates everyone. So the only thing is, the higher your capital, the higher your profit. So how much you have is how much capital you have will determine how much profit you want to make. So it accommodates everyone. If you want to open a shop, you know you need to first pay for the shop, you need to buy the goods and services. This one, all you need is your phone and your laptop. It's accessible. Even if you have small phone, yes, you can still trade with your small phones and make money. So these are the features or the advantage of trading forex. Please, in case you have any questions for me, or you can write it down on your notepad. By the end of the presentation, then we can take your questions. Okay, let's look at the best time to trade forex. What is the best time to trade forex? Now, remember, we talked about trading section. Now, one of the best time to trade forex is market section overlap. Market section overlap. I'm going to go back to that slide of market section to explain what I mean by market section overlap. Okay, now look at this. This is Sydney section. This is Tokyo section. Between let me see. Between this section, between this 1 a.m. to this 7 a.m., you will notice that Sydney and Tokyo are live. They are open at that point. Now, this is what we call section overlap. Between these points and then this point, sorry, and then this point, you will notice that at this point now, we have two sections that are open. Market tends to move when the market overlaps. Now, from this point to this point, you will notice that Tokyo and London, they overlap. This is also market overlap. Also, from this point to this point, you will notice that London and New York overlap. Now you can try to note down this period. Now at this period of market overlap, there is always volatility, much volatility. So when you are looking at trading, this is a good time to enter, in as much as, so all you need to now do is target the currency pairs and the currencies that fall under these sections, the currencies. So if you want to trade for this overlap, you now target Sydney and Tokyo currencies. If you want to trade this, you will target Tokyo and London currency. Why? If you want to trade this, you target London and New York currencies. Now, during this period, the market tends to move more, and this is what we call market overlap. I hope we are together. Okay, so let's go to the next one. Now, the next one, we'll call it market breakout. Now, this market breakout, we are going to talk about it better when we get to the advanced level in our trading. We'll talk about the market breakout. Now, there are periods in which the market has been ranging. They've been moving, ranging. I'm not going to dwell too much. When they break out, it's another time. There's always volatility. And then you can always take advantage. So all you need to do is, the moment you now understand market breakout, when you get to a chart, you can just begin to look out for where market has been ranging. Now, when you look out for it, target it and begin to watch out for their breakout. Then you trade it. Now, also doing fundamental news release. When the central bank of a particular country releases a news about their currency, there is always volatility. So let's say the Federal Reserve for US releases a news. Go and look at US dollars. You will see movement, spike. Now, this you can also trade. So all you need to do is, also you can watch out for any news release from different country and take advantage of the release. And lastly, markets are always volatile on Tuesdays, Wednesdays, and Thursday. Now, funny enough, the big guys don't trade on Mondays and Friday. They feel that Mondays and Friday, Mondays the market is not yet opened well actively, and Friday the market is already closed. So market tend to move more on Tuesdays, Wednesdays, and Thursdays. Now these are the best time to trade. So I want you to note this down, and when you begin to trade, you always take advantage of this. Are we together? If we are still together, please let's type in yes on the chat box. If we are together, please type in yes on the chat box. If we are together, please type in yes on the chat box. Okay, thank you, thank you, thank you. Now, let's look at what exactly can be traded in the financial markets. What exactly can be traded? Now that I have been mentioning currency doesn't mean that it is only currency that can be traded. It doesn't mean it's only currency. There are different trade assets. There are different asset class that can be traded. Currencies is one of it, and forex fall under currency. But doesn't mean it is only for currencies that we can trade. Currency is just one asset class. Now we have commodities, we have shares, we have indices, we have cryptocurrencies. All these are different asset class. So as a trader, you need to ask yourself, which of these asset class do you want to concentrate more on? It's not a must that you concentrate on everything, but it is better to concentrate on one. Now, when you concentrate on one and then you keep trading that particular one, over time you become master over it. In which, when they wake you up and ask you, what do you think about this? You will tell them categorically why. That's what expertise does. Expertise. When you continue to do the same thing over and over and over, you become expert on it. Now, this is the same thing. So when we talk about financial market, there are different asset classes that can be traded. We have currency, we have commodities, we have shares, we have indices, we have cryptocurrency. All these are different asset class. Now let's look at currency. Now, these are different countries' currency. Can you see it? It's a chart on different currencies. Now, this is a statistical measurement of the different countries and how people trade them. So we can see that the most traded currency is US dollar. The most highest traded currency is US dollar. And you can see that 87% of traders trade US dollar. Now, after US dollar, we have euro, we have Japanese yen, we have Britain pounds. Now, all this can be traded. Now, what's the essence of this information? The essence is it is foolishness. If it is foolishness for an individual that wants to trade because he feels that you can trade every currency, you now go and begin to trade South African rand. It is foolishness. Why? Because look at the percentage of traders that trade it. Now, what is the essence of this? When you trade the currency other traders trade, it moves more. It tends to be volatile. So if you are trading, because they say, okay, oh, you can trade any country's currency, and then you now go to South African rand and you begin to trade it, you will realize that you may not make money. Why? Because it may not move like that. Or maybe because they say you can trade any currency, and because you are in Nigeria, you now say you want to go and be trading naira. It's foolishness. The reason why you want to trade is you want to trade the currencies that are volatile, that people trade. Now, what makes it volatile is the fact that other people trade it. So when you trade what other people trade, you tend to make money. And this is where the knowledge comes in. So this is a chart showing us the different currencies and the percentage of traders that trade it. Now, these are different major currencies that people trade. We have US dollars, we have euro, we have Japanese. So as a trader, you need to know all the symbols of all the old currency. In which when you wake you up and say, what is the symbol for New Zealand dollar? You should be able to tell them NZD. So that is another assignment I'm giving you. So I'm giving you two assignments. So please, let's make sure you're doing the assignment to keep learning. Okay, so let's continue. Now, the next one is commodities. Commodities. Now, for those that are into the agriculture sector, now, funny enough, I may be a farmer, but I don't have a farm. I may be a farmer, but don't necessarily have a farm. How? I can be a farmer in the financial markets by trading commodities. So you can either trade agricultural commodities, you can trade energy commodities, or you can trade metals. So now, if you decide to trade on commodities, you need to ask yourself, which of these commodities do I want to trade? Do I want to trade the agriculture? Do I want to trade the energy? Or do I want to trade the metals? So this should also be what you should know before you begin to trade. So you don't just trade because you want to trade, but you should trade because you want to make money. Okay, so this is under commodities. The next one is indices. Indices. Now, indices is basically, now for indices, we have different indices. We have US 30, we have SPS, we have UK 100, we have Dash 30. Now, all this is you investing in different countries. No, sorry. When you're trading indices, this is you investing in different companies, being a shareholder in different companies, but not essentially a direct company. Now, what do I mean by this? Let me use US 30 as an example. What is the meaning of US 30? Now, US 30 is the top 30 companies, the top 30 companies in US. So if I decide to trade US 30, it is me investing in the aggregate of the top 30 companies in US. Are we together? Now, if I decide to invest in UK 100, it means that I'm investing in the top 100 companies in UK. So this is under indices. So you can say, yes, I want to concentrate more on indices. Yes, it's allowed. Are we together? Then we have cryptocurrency. We all know it. We have different coins. We have different cryptos. So you can just decide to concentrate on crypto. So the question now is, which asset class do you think you want to concentrate on? Is it currency? Is it indices? Is it cryptocurrency? Is it commodities? You need to ask yourself. But one thing I want you to understand is this: when picking your asset class, it is determined by the volume of capital that you have. If you are funding anything, let's say you funded an account and you want to trade, and let's say you funded below $1,000, and you now say, I want to trade commodities or I want to trade indices, it is foolishness. You will lose your money. Or you say you want to trade cryptocurrency, you will lose your money. Now, why do I say that? Now, the truth is this. Let me go back to the listing. When it comes to trading, it is when we concentrate about from commodities downward, the value you need to have to trade it must be higher. From commodities downward now, if you want to trade any of this, it's not for people that want to fund $100, they want to fund $500, they want to fund $1,000. They even $10,000. Fine, $10,000. You can still say you want to do maybe indices. Yes, you can still go for indices. But if you are going for shares, you are going for commodities, cryptocurrency, you need good money. Now, the reason why you need good money is they are much more volatile. When I mean volatile, they move much more. And what this means is, if they move in your favor, they will give you good money. But if they move against you, within seconds, you could lose your entire front. So while you are trading, the capital that you have, it also determines your asset class. And that's why in Nigeria, you see most people, they trade only currencies. Now, the reason is because of just the capital that we have. So it's your capital that really determines your asset class. When you have good capital and you're on commodities, you make good money. But if you are funding $1,000 and you say you want to trade commodity, it's foolishness. You may tend to lose it. So that's why when you're choosing your asset class, you need to understand how much you are even investing into. Are we still together? Are we still together? Okay, I hope I'm not boring us. I hope I'm still giving value. I hope I'm still giving value. I am not boring us. Okay, now, having said this, let's go to currency. We'll be talking about currency. Now, when talking about currency, one thing I want you to first understand is Mr. Tijani, it is well. It is well. But I may not be able to dwell on this too much. Our next class will take us more deeper because it's a whole lot. Really, forex is a whole lot of training, and that's why when I see people, they say, I ask them, how long have you been trading, and you tell me I've been trading for 1 month and you expect magic. I laugh. It's just like you want to become a medical doctor. To become a medical doctor, you know how many years you study in school, but you want to trade forex and you just feel in 1 month you want to be a master of all. It doesn't work that way. So let's continue. Now let's look at currencies. Now, when you are trading currency, one thing I want you to understand first is that currencies are traded in pairs. I want you to understand that when it comes to trading currencies, you need to understand that currencies are traded in pairs. So you don't just trade just one currency. You don't say, okay, I want to buy US dollar alone. No, you must buy US dollar against another currency. So if you look at my example now, we have euro USD. It means you are buying euro against US dollar. Now, let's look at the example. Let's look at an example. Now, if you have euro USD and you have this price, now what does this mean? One thing I want you to understand is when you see a currency pair, this is a currency pair. This is a currency pair. Now, any currency that comes first, in this currency pair, we see that euro comes first. Any currency that comes first, whatever you are doing is on that currency. Whatever you are doing is on that currency. Now, what do I mean by this? Now, if you decide to buy, if you decide to buy, now what this means is what I am really buying is the first currency. It is the first currency. If I decide to sell, if I decide to sell, sorry for my write-up, what I am really selling also, it is the first currency. So what this means is whatever you are doing is always on the first currency. So now, using this illustration, what it means is 1 unit of euro. If I decide to buy 1 unit of euro, the value, the amount it's going to cost me to buy 1 unit of euro is this amount in the second currency. So now let's use Naira, what we are used to. Let me put USD. Sorry. Okay, let me clean up. Okay, so let's say I have USD. US. I hope you understand what I'm writing. Or let me do it this way. Okay, if I have USD, then NGN. Okay. Now, let's say I have USD NGN. Now, remember I say whatever I am doing is always on the first currency. The first currency is this USD here. Now, it means that we all know, let's assume that the current exchange rate for USD is, let's say, 1,470. Let's just say it's 1,470. Now, what this means is if I want to buy if I want to buy $1, I'm going to need 1,470 naira. Now, that is the same thing with this explanation. So anytime you see something like this, what it means is one of the first currency is what the price of the second currency. I hope I'm making sense. I want to be sure I'm making sense. Please, if this is making sense, please type in sense on the chat box. If this is making sense, please type in sense on the chat box. I want to be sure you understand my explanation. Okay, good, 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 good. Is it only Mr. Tijani that is here? Because I can see Mr. Tijani already have an idea. Now, this is why I try as much as possible not to bore us too much with trading. Mr. Tijani is easy for him because he already have an idea. But we have Mr. Jesuloba here. He's confused because he does not have an idea, which I understand. Any other person, please, let's hear your opinion. Especially those people that are new. And I want everybody to get value. I don't want to just teach one person here. Okay, Mr. Sheriff, are you still together? Mr. Sheriff, is this making sense to you? Okay. Okay. Now, for those that don't understand it, don't worry. This class is recorded. Is recorded. You can always rewatch it. I will make the recordings. I will upload it on YouTube and make it available through the medium you joined this class. So wherever the group you can have access to the recording and you can watch it over and over and over again. Over time, you'll get used to it. Okay, so let's continue. People said all this. So this is just to explain currency pair. So the summary is number one. When it comes to you trading currency, currency are traded in two, not one. You are trading one currency against another currency. You are not just trading one currency, but currencies you trade it one against another. Are we together? So, and when it comes to, remember, I also said whatever you are doing is always on the currency that comes first. So, it's number one, when you see a currency pair, ask yourself which currency comes first. Now, if you are buying, it means you are buying the first currency. If you are selling, it means you are selling the first currency. So, whichever you're doing is always on the first currency. And the second currency is the worth of the first currency. The second currency determines the worth, that is how much, the value at which you are buying the first currency. So that's just a summary of what I have said so far. Okay, so let's continue. Now let's look at the type of currency pairs. Let's look at the type of currency pairs. Now, when it comes to currency pairs are grouped into three categories. They are grouped into three categories. The first one, we call it the major currency pairs. The second one, we call it the cross or the minor currency pair. And the third one, we call it the exotic currency pair. Now, as a trader, when you see a particular currency, you must be able to tell us the category to which that currency falls. So now, if I see a currency pair, I should say, oh, okay, this one is under exotic. Oh, this one is under major. Oh, this one is under minor. So you must be able to determine the category at which a currency is grouped. Now, let's pick the category one after the other. Now, the first one is called the major currency pair. Now, when we talk about the major currency pair, one thing I want you to understand is the major currency pair are the most traded pairs. They are the most traded. The major currency pairs are the most traded currency pairs. So as a trader, when you want to trade, you must always target the major currency pair, especially for newbies. For newbies, target the major currency pair. Now, the question is, why do I want to trade the major currency pair? Number one, the costs at which, number one, major currency pair are more volatile. They move very well. They move in a steady, in a consistent way. If you really understand the way to which a market move, if they want to go on a up, they move up. If they want to go on down, they move down. So they move in a major direction. That's one. Then number two, for a major currency, the cost you need to pay for trading is always lower compared to the remaining categories. So the cost of transaction you are paying is much more lower compared to other currency. It's much more lower compared to other currency. So this is the reason why you want to concentrate more on the major currency pair. Now let's go to the second one, which is the cross currency pair or the minor currency pair. Now, for the cross currency pair, okay, wait, let me go back. A minute, please. Now, how do you identify a major currency pair? Now, any currency that is paired with US dollar, any of the major currency, let me put it that way. When I mean major currency, I mean currency that are much traded. Let me show you what I mean by major currency. Let me go back to my slide. A minute, please. I want to show you what I mean by major currency now. Now, look at it. This is major currency. Can you see? This is major currency. These are the major currency. Now, when we now talk about major currency pair, any of this major currency paired with US dollar is known as major currency pair. That is any of this from this downward here, any of this currency that is paired with US dollar. Now, US dollar can either be the first currency or it can be the second. It's insignificant. But when you look at the two, you must be able to see US dollar and then you see any of this. So if you see any of these and then you see US dollar, then it falls under major currency pairs. So can we easily identify? Let me know now. I want to ask, if I show you, do you think you can easily identify a major currency pair now? Based on my explanation, do you think you can identify a major currency pair? Yes or no? Yes or no? Can you easily identify a major currency pair? Yes or no? I'm not seeing our response, so hope I'm not alone. Okay, 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 perfect, perfect, perfect. Let's go on. Perfect, perfect. Okay, a minute, please. Okay, so let's go to the minor currency pair. How do we identify? Now, for the minor currency pair, these are less traded pairs. So the rate at which people trade minor is not like major. They are less traded, but still, people trade them. Now, the difference is this. If I want to trade a minor currency pair and I place the trade, the cost I'm going to pay for picking any of these is much higher than the cost I paid for the major. So those are the reason why. And people feel, am I not still making money? So why do I want to pay much more just to make money? Fine, you can trade it. I trade it. You can trade it. But it's better you start with the major first. So when you are now good, you can now begin to increase the what you want to trade. Now, how do you identify a cross currency pair? To identify it, any of the major currency that does not have US dollar. So for the minor or the cross currency, it is the major currency pairing themselves. The major currency, those ones I show you outside the dollar now, they are pairing themselves. They will not have US dollar at all. They must be one of the major, but they will not have US dollar. So when you have such, then you know they are the minor or the cross currency pair. Now let's go to the last one, which is the exotic. Now the exotic currency pairs. Now these are pairs involving a major currency. Now involving, how do you identify an exotic? US dollar paired with any of a developing economic currency. I repeat, how do you identify what's the name now? An exotic. Any of the major currency, either US dollar or any of them, pairing a developing economic currency. Now, if you look at all this currency here, you will notice they are not part of the major currency. These are developing economy. Now, Nigeria is a developing economy. So when you see US dollar against Naira, it also fall under exotic. So any of these paired with it is an exotic. Now, please note, exotic are less traded. People hardly trade exotic. I don't even go there. I don't trade it. Seriously, I don't trade it. And the cost of trading is very, very high. The cost of trading it is very high. I don't trade it. I've never traded it. So I don't see a reason. So, but one thing I want you to understand is, if you don't know how to identify the types, you will find yourself trading it without you even knowing you're trading an exotic pair. And that's why, as a trader, you need to be able to differentiate the different category so that you will not find yourself trading what you shouldn't trade. Are we together? So these are the different type of currency pairs. Now let's look at the most actively traded currency. Which are those currency that people trade more? So you can see the highest is US dollar. Can you see it? The highest is euro. Sorry, the highest is euro USD. People trade euro USD more, followed by USD JPY, followed by GBP USD, before we now have the rest. So the highest that people trade is Euro USD. So this will just be a guide so that when you want to start trading, you don't just trade what is not necessary. You just want, the most important thing is to make money, not to give yourself too much pressure on which one do I want to trade, which one do I just click on one, make money and get out of the market. That's the most important thing. Okay, so let's continue. Now, let's look at speculative trading. Speculative trading. Now, the question is, how do we make money in the financial market? Remember, I explained earlier that when it comes to making money, we are trying to make money from speculation. Speculation. Now, to make money, what we want to achieve is this. You want to be able to determine the direction to which market will go. Now, the truth is, when it comes to forex trading, there are two ways to make money. So there are two major ways. How do you make money? Now, you make money basically by the ability to be at the right side of the market at the right time. I repeat, you make money by the ability to be at the right side of the market at the right time. Now, if I decide to buy, what this means is I have a feeling that price from whichever level I want to buy from is going to go up. Now, when I believe price is going to go up and I enter the market for a buy and price begins to go up, I make money. That's one side to make money. Now, the second side to make money is if I believe that price is going to drop, that the value, let's say I want to buy when I see that currently price is around 20 naira. And I feel that from this 20 naira, price will drop. It may go to 12 naira. Now, if I enter the market on a sell position and price begin to drop, I will also make money. And this is why I said, for you to make money in the financial market, you need to be at the right side of the market at the right time. The moment I enter the market for a buy, and instead of price going up, price begin to drop, I lose money. Or if I enter the market for a sell and instead of price dropping, price begin to go up, I lose money. And that's why I said to make money in the financial market, you need to be at the right side of the market at the right time. Market is going up, I buy. Market is going down, I sell. Now look at an illustration. Let's assume I was at this level when the market is here. Now, from this point, what happens? Market drop. If I enter the market for a sell, what happens? I make money. Now, if at this point I can see, oh, the market is going to go up, and I enter the market for a buy, and it went up, I make money. So imagine within how many days I make money for the buy, for the sell. I make money for the buy on Euro USD. So that's why I said Euro USD is much more stable. So it now has to do with, now the question now is, how do I know if market is going to go up or if market is going to go down? That we will get to when we get to the complex training. Are we all together? So this is just to explain in detail how we make money here. Speculation, trying to be at the right side of the market at the right time. That is how we make money. Okay. I hope we are still together. I hope we are still together. Now, before you place your first trade, what are those things you need to know before you place your first trade? Now, I tell people it goes beyond you saying, I want to trade, I want to trade. No, there are three things you need to know or you need to understand before you place your first trade. Number one, your entry price. Your entry price. Now, what do I mean by this? This is the price at which you want to execute your trade. Now, you don't just execute because you feel I want to buy. No. So before you know when to buy, I must be able to tell myself when I'm analyzing, I will tell myself that okay, when price is at this point, I want to sell or I want to buy. So that price is the entry price. The second one, we call it the take profit. Now, this is you telling the broker that you are willing to take your profit for every trade you place at a particular point. So when you put in your take profit, it is you saying that, okay, at this point, I want to take my profit. So that's the take profit. And the third one is the stop loss. Now, as a trader, I tell people it is not just about profit. There must be a point you want to accept your loss. Now, there is a rule in investment generally. The rule of investment is the higher your risk, the higher your reward. Now, the question is, how do you determine your risk? You determine your risk with your stop loss. So, the stop loss is you telling your broker how much you are willing to lose or risk for every trade you take. So, before you place your trade, you should be able to ask yourself, at what point do I want to enter? And at what point do I want to come out? Remember, when you're coming out either in profit or in loss. Now, the moment you cannot give an answer to these questions, then you are gambling. You're not trading, you are gambling. Now, if you look at this chart, look at it. Let's assume this person entered at this first line. You can see where he entered for a buy. Now, he targeted this point as his take profit. Price got there. If he did not take his profit at this point, what happened? Price came back and it went back to the point he entered the market. So the importance of take profit and stop loss is the ability not to lose the money you have already made. Because many people, they will have made money, but at the end of the day, they will still lose that money. It's foolishness. So you should be able to protect every penny that you made in the market so that you won't lose it again. Are we together? So this should be something you should learn. You should know before you even place your first trade. Now, what do you need to start trading Forex? Let's look at what you need to start trading. Number one, you need a personal computer or a smartphone. It is one thing you need. Now, it is good if you have the two, but one is a must have. Either you have a PC or you have a phone. Let me use myself as an example. I use my PC to analyze the market, while I use my phone to place the trade. So this is because I have the two. Yes, we have some people that use their phone, but for both the analysis and placing the trade is okay. But it's much more convenient when you have the two. But you can start with one and get to the level of having the two over time. That is one. The second thing you need is a stable internet. You don't want to find yourself in a situation whereby you enter the trade, and when it was time to close it, your internet, Nigerian internet, did this strong thing. And at the end of the day, you end up losing money as a result of the internet. That can happen. So as a trader, you need a stable and high-speed internet connection. You don't play with that. I tell people, as a trader, internet is your food. It shouldn't be something that you are managing. It should be your food, what you need to have. Then another thing you need funds, you need capital. Yes, as a trader, it's important that that you start with a demo account. Yes, that's true. But at the same time, you need capital. Now, I tell people the higher the capital you have, the higher the opportunities you can take in the market. Yes, you can decide to have any amount, but the truth is you need to ask yourself, how much do I want to really trade with? You need a capital. And lastly, you need a reliable and trusted Forex broker. You need a reliable and trusted Forex broker. Now, this will give you access to the financial market, because without a broker, you cannot get access to the financial market. So you will need a trusted and reliable broker. Are we together? Now, these are what you need to trade. Now, with this, I've come to the end of my module 1, today's presentation. And I want to believe you have learned one or two things. Now, let's go back to what you need. Out of what you need, because at this point, for you to join this presentation to the end, it means you want to start trading. So the question you need to ask yourself is, how many of these do I have? Now, if you are here and you have not opened an account, I told you this training was brought to you by trade.com. Trade.com is a forex brokerage firm. Now, if you are here and you've not opened an account, a forex trading account with trade.com, I want you to type, if you have opened an account, I want you to say yes. If you have not opened an account, I want you to say no. Let's start with that. If you have opened an account with trade.com, I want you to type yes. And if you have not opened, type in no.